Are you wondering what is happening with the markets? Where are we? Are the markets going up the next few months? Are the markets going down? You are looking at the S&P 500 on a weekly basis going back 10 years. I'm going to give you a perspective that I think is very unique. Who am I? I am Bagadon at StockMarketCaddy.com, and today is Sunday, February 5th at 1 o'clock. And let me just say this. We trade our own money, and our members trade their own money intraday on a very short-term basis. You might say that they're on the field. They're not in the stands. They're not on the 50-yard line or in the first tier or in the skyboxes necessarily investing for the long term. They're on the field. They're playing the game. They're on stage. They're playing the piano. They're not in the audience. Now, there's nothing wrong with being in the audience. There is nothing wrong with being in the stands and wanting to know the outcome of the game. What is happening? So, whereby it is February 5th, the end of January, we thought we would apply our skill set and give you a very unique perspective. Please understand, though, I'm not a financial advisor. I'm not a broker. I'm not making specific recommendations for anyone to buy or sell anything. It is just a perspective, and I think you'll find it very interesting. This chart shows the S&P 500, the move from 2013, and it's been a hell of a move. Now, these red lines were drawn by the computer, the red line, the yellow line, and the green line. What is it doing? It is mapping out automatically the range, the weekly range over a 20-week period. So it's very slow. It shows us the all-time high of the S&P 500. And by the way, the S&P 500 is the biggest, deepest market in the world. Whatever happens to the S&P 500 is going to happen to the Dow, happen to the Russell, happen to just about everything. Now, at this point, the S&P peaked at 4818.62. This low range down here was at 2191.86. This is the COVID low. This is where the market did in fact panic that we would move into a recession because of the shutdowns over COVID. Now, miraculously, the market stopped going down and did this. Now, we're going to show you in a moment why that may have happened and why the market pulled back. And what is interesting to us, and hopefully to you, is that the market pulled off of its high and came down within 10 points of the midpoint. This is the midpoint. It came within on this day, which was October 14th of 2022. It came down to 3491.58, within 10 to 15 points of the midpoint. You see, folks, when stocks in markets go up or down, they have a tendency to retrace 50%. And then they become noisy and the battle lines are drawn. Are we going back up to the highs, or are we going to turn and take out the lows? Now, remember what I said. As the market ran up, they have a tendency to retrace, and it did retrace 50%, but it also ran up. And when you calculate the distance, and I'll let you do this, we won't do it now, but when you calculate the distance, which is between here and here, it's approximately 1,300 points, and if you divide that by 2, we have bounced just about 50% between these two lines. And you might say, what does that matter? Well, it matters because when you retrace 50%, the people and institutions that purchased stock up here become very fearful. They may have lost 50% of their portfolio. And when the market bounces 50%, they're not down as much. They're not whole if they bought up here, but they begin to get close to being whole. And they begin to think and act, well, maybe I'll get some of my money back and I will begin to do what? Sell. And that is referred to as overhead supply. As we bounce. So there are folks saying that we're going to the old high and we're going to continue. Maybe. But maybe we're going to stop here because these people want their bread and they begin to sell and we come back down. And maybe we break this and maybe we revisit that low. That wouldn't be good. How might we know? Well, looking at this chart, and we have our proprietary paint bar on here. This was the warning that the market was coming down. I want you to look here. We're at 41.36. Now follow me here. Take this cursor to over here. The last time we were at 41.36 was over here. Do you see? This is a momentum indicator. Do you see how strong the momentum was when we were last at 41.36? Do you notice how when we started to go up, the momentum started to slow, and then the momentum turned negative? But Don, we've had a rally. Yes, we have. And we're back to 41.36. I think we're going back up here. Look where the momentum is. Here. Not here. Might this just be a dead cat bounce? Sorry, Gracie. She doesn't like when I refer to that. That's what it looks like to us. But let me show you something else. And this is going to be worth your 5 or 10 minutes. I'm going to come here. Bear with me. Excuse me. I'm going to come to Edit Symbol. And I've loaded in the short-term interest rate. Don, what does the short-term interest rate have to do with anything? Well, it has to do with everything. And I'm going to bring it in as we've painted it magenta. And stay with me. It's very, very simple. And hopefully it's going to populate, and there it is. The short-term interest rate is what you get when you buy a 90-day CD. And when the interest rates are really, really low, people and institutions and companies put their money into their stock to get a return. Remember, Tina, there is no other place. I need to get a return on my retirement monies. Notice when the COVID lows came in, notice what happened to interest rates. They plummeted. That was manufactured by the Federal Reserve. And notice that the Federal Reserve controlled the short-term interest rates, and they kept them very, very low. And that is what put the momentum into the market. But Don, look here, the interest rates started to rise. Yes, the Federal Reserve signaled to market participants and their friends and family that we're going to increase interest rates. The interest rates along here were virtually at zero. As they started to increase them ever so slightly, look what happened. The short-term interest rate on 90-day paper is no longer zero. In fact, in February, he increased it another 25 basis points. It is at 4.75. So let me ask you, you have $100,000. Do you want to put $100,000 into GE stock with a 2% dividend that might run into hard times, might do this, might do that? Or do you want to take your $100,000 and put it into short-term treasuries yielding 4.75 and maybe 5%, 5.5% in the months ahead? If the answer to that is yes, and everyone else does that, This market is likely to come right back down, breach 3505, and we would suggest a very real possibility in the weeks and months ahead, revisit 2191. I'm Bagadon at StockMarketCaddy.com. I hope you've enjoyed this 10 minutes. You're more than welcome to visit our website, ask us any questions about who we are not, and you're also welcome to call at 813-758-8263. We hope you have a great week. For us, we will be on the field tonight, tomorrow, the next day, and the day after that. But we thought we would share a long-term perspective with those that are playing the long-term game. Be careful. Good luck.